My name is Ivan Illan. I'm the founder and chief investment officer for Aligne Wealth Advisors, Investment Management, otherwise known as AWAIM. I'm very happy that you have joined me today. I want to go through our July capital markets and economic perspectives with you. And it is Casual Friday, so I don't have a tie on today. I hope you are all right with that. And with that, I will jump into what we've been working on and what things have been going. And, the folks that mostly attend this are our clients. So very happy if others are also attending as well. Welcome. Again, this is for July. Here are disclosures that I would really appreciate if you read thoroughly. And if you have any questions, please do reach out to us. On Monday, August 1st, I'll have an article coming out in Forbes. The next article is about financial advisors and how they use hypothetical, not actual performance in their marketing material. This has become a big, dominant thing out in the marketplace. And I think a lot of retail investors don't really understand when they're being shown an investment proposal, what is the nature of those returns and who delivered those, if anyone. And so some of you may find that of interest. For the month of July, we only did one thing, which is a full rebalance across all of our portfolios back to target allocations. And essentially this means that we've continued to maintain a higher cash allocation across the full suite of our portfolios. Also meant we bought a little bit more of financials, emerging markets, US mid-cap. Means we sold a little bit of our energy, healthcare, and developed non-US. It just depends on exactly the timing in which you entered into these strategies. So that would impact the level of buy or sell in these different areas. Please look at your account view and you'll be able to see more specifically. Regarding the most aggressive strategy that we offer and manage for you is the 090 Portfolio strategy, which targets generally around a 90% allocation towards equities. It's off around 14.91% net of all fees through the end of June. And we compare that to the benchmark, its blended benchmark on a gross of fees, so before any fees, because you can't invest directly into an index. So it's not quite apples to apples, but it gives you a pretty good representation of what we're accomplishing year to date, outperforming fairly significantly on a year to date basis through the end of June, and on a 12-month rolling basis, 1 year, June to June, still outperforming quite well. And then there's some convergence of that portfolio performance as we look further back through time. But you really get a sense of the equity allocation changes we made back in 2020 and 2021. Certainly have been playing out quite nicely in this strategy, which we're very pleased with. And then on the 060 portfolio strategy, this is down about 13.15%. And the benchmark on a gross basis is down 17.53. Again, that 13.15 of this strategy is on a net of all fees basis. And it too has been outperforming by a few hundred basis points. And we're quite pleased with this. And certainly most of this outperformance is due to the fact that we don't have a lot of intermediate bonds, long-term bonds. Really all of our bond exposure has been on the very, very short end of the yield curve. And we've been parked out there for some time, which hurt us several years ago, but of course now is helping us tremendously. And doing a better job of preserving capital than the broader index. And we're hopeful here in the next couple of months, we're going to be having maybe, next 2 to 6 months, we'll have some opportunities to buy into these higher yields within the US corporate bond market in particular. And certainly they've come up quite a lot in a very short period of time. And they may, in fact, go a little higher. It just depends on how challenging things get in the next few months. Here's a little bit of narrative for you regarding our economic outlook and capital markets forecast. The first is equity markets. The stock market is anticipated to be volatile and continue to be volatile as the Federal Reserve continues their aggressive monetary policy. Also, non-US stocks developed and emerging remain more attractive to us. The dollar strength, as strong as it continues to have been this year and really specifically over the past 3 months, it'll weigh on large cap exports, the demand for these more expensive goods, because essentially the US is exporting inflation around the world. Interest rates are expected to stay at these higher levels. And in fact, we're anticipating maybe a little bit higher as the Federal Reserve gets more restrictive in the fall. This is going to have some kind of impact, we anticipate, on debt service coverage for US corporations. This is going to challenge how they're going to maintain their debt payments, but more specifically, when they're faced with a refinance of a bond or a loan, they are going to figure out how to pay that down or pay it off and refi a certain amount. So that will obviously create some liquidity constraints, because CFOs don't necessarily like to use their cash, but they may have no other choice but to use their cash. So this is all part of what it looks like when you get into a restrictive monetary policy mode by a central bank. All that money that was injected, trillions of dollars that was injected into the marketplace, is now being sopped up, being mopped up by the Federal Reserve. And it occurs in these capital decisions that business owners and investors have to make. So it really is about monetary policy right now. This is a very big central theme, and the navigation through it is incredibly important in terms of your capital allocations. There's been some interesting economic data. Obviously, we have continued to see very, very tight U.S. workforce. It continues to be very tight, and millions are still not back in the workforce. It's so strange because supposedly we just had a recession, quote unquote, because we had 2 quarters of negative U.S. GDP. But really, when you look at it, you don't have very high unemployment. People still have a lot of money in the bank. People are still spending. So people are spending. People are feeling good about having the money in the bank, and that money isn't disappearing tomorrow. So inflation hasn't gotten so bad to really stop all of this behavior of spending. And that certainly concerns the Federal Reserve. So keep on the watch of what they're doing and what they're deciding. That's certainly what we are doing. Personal household savings, again, like I said, still at very high levels, and spending hasn't slowed enough. Check out my blog. I added a couple in the month of July, one talking about personal consumption expenditures, and posted that a couple of days ago and said that if that number came in at 17 trillion or higher, that the Fed is probably going to be taking that in as a big factor to their decision making going forward. And it did come in this morning at 17 trillion. So there's certainly some concern here that the Fed may step up their may have to step up their rate hike cycle and the pace of it and the level of it over the next few months to really create some serious change in the consumer behavior. And also looked at some B-rated debt and the option adjusted spreads around it. They're not quite yet at the level that we think really reflects a risk, an elevated risk perception level. So we're really hanging out waiting for that. Thank you so much for joining me. Please feel free to scan this little thing. It goes directly to the blog. And then you can email us at info@alignwealthllc.com or give us a call at 310-795-0622. And so very happy that you were able to join me today. Thank you, and talk to you again soon.